The number one impact of rising interest rates, obviously cash flows, if you have a cash flow project. But the biggest issue is cap rate. What is the cap rate today for this type of a project as completed? And then you bring it to the market 2 years from now, what the cap rate might be. So it's speculative. The way we look at this, there are two possible scenarios. One I call it stagflation, and the other one is your classic recession. And you got to be prepared for both. Under what circumstances holding cash is good in the highly inflationary environment? And the answer is two scenarios. Number one, instead of keeping cash, you keep the money invested into something that's forward. The second scenario is cash is good if you know you're going to get really good deal or better deals coming. Are you investing in the projects that are performing today, or are you investing in the projects with some value?
Well, because what you do as a fund manager of the number of different tempo funds that you help us as investors allocate our capital into, obviously you're out there in the marketplace all the time with known sponsors that you work with regularly. You're always looking at potentially new sponsors and new opportunities with either known sponsors and kind of deal flow that you're pretty accustomed to. I know a lot of things you're doing, like is conversion of hotels to workforce housing. That's one area that's been very, very solid this last year. There's a number of other areas. What are you hearing? What are you talking about with your particular sponsors in terms of how they are, stress testing the current environment? What different underwriting criteria, or we could call it a buy box. We talk about a buy box. That means criteria that they are looking at when they make an acquisition. For us as an investor, it would be our investor box. But I want to hear from you, kind of what your words are, your language, your conversations are around changing underwriting criteria in the current market.
Sure. So it's a great question. The number one impact of rising interest rates, obviously cash flows, if you have a cash flow project. The asset type and the strategy that you mentioned, conversion of hotel to multifamily assets, they don't cash flow. We basically terminate them as hotels and convert them to typically affordable workforce housing, multifamily. So the cash flow is not really an issue. But the biggest issue is cap rates. So what typically interest rates do, they increase the cost of financing, and the next buyer will probably want to pay a lower price and higher cap rate for the same product. So that's a critical underwriting requirement. What is the cap rate? What is the cap rate today for this type of a project as completed? And then you bring it to the market 2 years from now, what the cap rate might be. So it's speculative. Right now, cap rates have not gone up, even with rising interest rates. But in theory, there is a correlation. So the normal stress test scenario on these type of deals, what are you seeing today? What's the cap rate on this type of property? It's 5.5%. Well, what are we underwriting it for? What's the exit cap rate? We're underwriting it for 6. Well, let's push it to 6.5. Let's push it to 7. Does the deal still make sense? And if it does make sense, you can basically feel strongly about downside protection. Because your all-in cost basis, let's just use an example. Your all-in cost basis is $10 million, and you're projecting to sell it at $14 million upon completion of this conversion of hotel to multifamily. So with cap rate change, if you go from, say, 6 to 6.5, that $14 million price may look like 13 or 12.5. Is this still acceptable? Is this enough of a return to investors? So that's one stress condition. The other stress condition, what happens if the market really tanks? Can the cash flow be sufficient to support the asset? So from an underwriting perspective, you complete the value add, and at that point you're refinancing because you can't really sell. Can you at least have a break-even cash flow? So can you survive with this asset? These are the type of questions that we look at to make sure that the stress conditions don't put the deal into a problem. The beauty about multifamily, at least the right type of projects, is that there is also, besides the cap rate approach, in this inflationary environment, there's a cost basis approach. What do people pay per door? And each door rents at a certain average rent. So at least the strength of this inflationary environment is if you pay the right price per door, that this asset has pretty strong downside protection because the cost to reconstruct the materials, the labor, continue to go up. And as the result, at least you have that protection in the deal. So we also look on a cost basis. What are we in for per door? So use an example, it's $70,000 a door or $100,000 a door. and this thing rents at $900 a month, at $70,000 a door, we know it's going to cash flow really well upon refinance, even if the interest rates go up a couple hundred basis points.
Yeah, the cash flow, as you said a moment ago, is what I look at as the key. What is that cash flow? Can we sustain? Everybody comes into the acquisition of an investment with some idea of what the exit is going to look like. And yes, typically in syndications, there is an exit, at 3, 4, 5, 6, maybe 7 years. There's some hold period during the value add in which the value creation is there. And then the syndicator, the sponsor determines now's a good time to sell. We've got a good multiple on it. Let's make the exit and we'll go on to the next deal. Now in this marketplace today, we go, well, that time period may be extended beyond what the run rate's been the last 3, 4, 5, 6 years, right? So having that cash flow allows that operator to sustain through a market where maybe the exit timing is not good at 3 years or 4 years or 5 years, whatever is anticipated. As long as they have that capability, and we as the investor know that we may need to stay in for a longer ride, as long as we got the cash flow, we're essentially okay. It's those that are tight on cash flow or tight on cash period that many times in a market where they can't exit on a time basis that they predicted, then they have to start selling that asset or other assets at discounts, and then you have this domino effect in the market. So you just don't want to be one of those, right? You want to be on the side of those who have predictable cash flow, sustainable to get through that, and then you're not a seller at a discount. Would that be fair?
Yeah, for sure. You definitely don't want to be forced to sell. That's the rule number one. You want to sell at your own terms and on your own time. So from investment perspective today, basically we're looking at the things two ways. One, what do we got in our portfolio, and how these assets are progressing through their life cycle, and at which point can they go through a refi? And obviously, with the rising interest rate environment, we're pushing very hard right now on the assets that have gone through value add, can they refi as soon as possible? And that's basically one of the things you can do today. You could still try to refi. And even though the costs are higher than they were a few months back, it might still be worth going through the exercise rather than waiting another 6 months and see what's going to happen. Although I'll mention this point, Fed is raising short-term interest rates. Fed can really control their Fed discount rate, and that impacts basically short-term rates. And then they also have their balance sheet as a tool to push long-term rates higher as well, by virtue of not renewing maturing securities or selling securities in the open market. It's the quantitative tightening. What's interesting is what's going to happen to a 10-year Treasury and mortgage rates. Depending who you listen to, there are some theories that the 10-year Treasuries, which control the mortgage rates, may be topping out in essence, may go up, or it may actually stay where it is, even though the short-term rates will go up. It'll create what is known as an inverted yield curve. Yeah. And not to speculate on the subject, we need to be prepared for both scenarios. One scenario where these mortgage rates, they've gone up, but they will stabilize. It might hover up and down another quarter point, maybe even 50 basis points, but they're not going to go up from just under 3% now to 5%. That scenario is pretty extreme. And if we go into recession, that long-term interest rate, it is typically an indicator of a long-term inflation expectation, right? So it's very possible that if we go into some kind of recession, long-term rate will not pick up as much as some folks are concerned. And then in that scenario, at least we're dealing with a situation where it's not as much of a pressure. But on the other side, if the inflation continues to be raging, the Fed may be doing the balance sheet deleveraging, pushing the long-term rates up as well. So there's a little bit of speculation, but something to keep in mind that we don't panic. We basically prepare ourselves for multiple scenarios. By the way, I'm going to just mention this, and I'm going to take a step back. The way we look at this, there are two probable possible scenarios. One I call it stagflation, and the other one is your classic recession. And you got to be prepared for both.
Well, let's talk about that a little bit. Since you mentioned it, stagflation, That's where we have inflation that continues on, but we have an economy that is really kind of, I'd say, anemic. No growth, nothing really happening, right? So that would be kind of the basic stagflation. Then compare and contrast that to as you said, a kind of conventional recession. What's a conventional recession look like then?
Sure. So let me provide a comment first on stagflation. So stagflation is a high inflation, and by the way, the Fed's raising interest rates cannot fix inflation problem, because the inflation is driven, at least the bulk of the inflation is driven by two things. One is let's call it supply chain problems. When the supply is limited, and there's a lot of dollars in circulation, it's 10 apples, $10. When you cut the number of apples to 5 and number of dollars to 20, the price goes up per apple. And then the other element is energy. So US energy policy, unfortunately, is not very conducive to curb the inflation. Energy goes into everything. It goes into transportation, production. So the result of the current energy policy is that we can't get inflation under control. So that's a very strong driver of likely inflation. Now, stagflation is typically, by definition, is very slow, possible negative growth. Q1 gross domestic product was a negative 1.4%. It's very possible that Q2 could actually be a negative print, which basically signal effectively recession from the GDP perspective, but inflation is still raging. So that's your classic scenario number one. And then the typical recession scenario doesn't have this kind of inflation. So if to go into a traditional recession scenario, we need to start seeing inflation curbing down quite a bit. And can this happen? It can. We've seen inflation spike up, hit a high level, and then spike down. It happened, by the way, in pre-2008 crisis. There was a spike in inflation, and then all of a sudden it just kind of fell off. The bottom fell off the floor. Is this likely today? I don't think so, but it is possible that inflation will start slowing down. So as inflation starts slowing down, also unemployment has to start showing the signs of worsening. We are at 3.6% unemployment rate, which is very low. There's almost a great amount of data on the point that at this level, it's probably as low as it'll ever go, which means that we're probably going to see increasing unemployment. And over a period of time, we'll be in a technical recession. We're starting from pretty full employment, at least from that perspective. So compare and contrast. One scenario, we continue to have still rapidly, I don't want to call it ravaging inflation, in the 8% plus range. Can it go over 10? It can, but the likely scenario, the reported CPI will start coming down, hopefully below 8% print. And then we'll be still looking at some form of a stagflation, just not as bad as the last couple of months.
All right, last question, Mike, and we know we're not giving any specific financial advice to anybody here, so we're talking in general. But you know, I get a lot of questions from people. I know you do too. Investors who maybe they're new to investing, they're new to the markets. This is kind of their first rodeo in terms of seeing headwinds like we're seeing right now. So there's fear. There's a certain amount of panic out there. What people see in their stock market and 401ks have dropped since the first of the year. So there's this new panic in the arena with all that we've been talking about. What do you do? You know, you've got some assets, maybe you got some cash, maybe you just had a liquidity event, you sold a business or had some other event that gave you some cash, and some people say, well, you better get that cash invested somewhere, because if you don't, you know, the inflation is going to eat it up over time, which, yeah, over time it will. I better get invested somewhere. What do you say about that? The balance between holding on to some cash versus got to get invested.
Sure, Dave, that's an awesome question. That's a fundamental question. So let me answer it a few different ways. So the first answer is, under what circumstances holding cash is good in the highly inflationary environment? And the answer is the two scenarios. Number one, when you hold, instead of keeping cash, you keep the money invested into something that's falling, right? The cash is better than a losing investment. The second scenario is cash is good if you know you're going to get really good deal or better deals coming. That's where the value, even though it's the dollar is losing the value through the inflationary pressures, but it's still not a worst thing in the world. Now, all that said, you're still better off investing. And what are the great investments in this environment? And without giving any advice, kind of stagflation 101. What's bad? What's bad are growth stocks, and what's bad are bonds. If the interest rates are rising, bonds erode value, and growth stocks, they're taking it in the chin because they have leveraged balance sheet. These companies, just their profits are shrinking as a result of this environment. What is generally good in the stagflationary environment? Real estate. Real estate is one of the best asset classes where to put the money. There are a couple of other asset classes, what is known as value stocks. So if you are, I'm not a stock picker, I'm not Warren Buffett of the stock market. I do it, I love Warren Buffett, but I love it in real estate. If you can pick the right value stocks, so much power to you. And then the other asset class is generally commodities. So energy has been a solid investment in this environment, probably going to stay solid until at some point we'll get some more energy production, different political environment. But stocks, and again, stocks are not good, traditional stocks, the growth stocks. And back to real estate. So real estate is phenomenal. Real estate could be a great hedge against inflation. And real estate could also provide a safety mechanism. But you have to pick the deals. You have to get very, very prudent about picking the deals. You're obviously aware of the quadrant methodology that I developed. And then the quadrant methodology, your audience may not know, but we have the investment grade quadrants and speculative grade quadrants. Investment grade quadrants are those deals that basically, or the deals that fall in those quadrants, they are deals with good downside protection. So what's really important is to pick real estate deals, but the deals that are typically properly leveraged or lightly leveraged or not leveraged. In addition to that, they have good downside protection mechanisms. And these mechanisms need to be well understood and well stress tested. And if you go into these deals with a higher degree of confidence that you are well downside protected, then you have the opportunity to still catch substantial hedge against inflation, as well as projects that have value add component. That's another really important element in investing. Are you investing in the projects that are performing today, or are you investing in the projects with some value? And if you're investing with competent folks, and Freedom Founders Network is that, a group of trusted advisors, folks with great abilities to execute value strategies. And that makes all the difference in the world, because you can create downside protection through forced appreciations, through these projects that build value regardless of what happens in the market.
Well, Mike Zlotnick, that's golden advice right there. I think you really, you thread the needle on that one so well. I think that's a good place for us to end this segment, but always a pleasure. You bring so much wisdom and experience to every conversation we have. I've enjoyed it over many years with you, and we'll continue to go forward during this somewhat tumultuous time. But again, navigating it is what we do. It's fun, and we'll continue to carry on. So thank you, sir.
Thank you, David. Always appreciate you, your wisdom, and grateful for the opportunity to serve the Freedom Founder community.
If you enjoyed watching or learning from this video, please leave a like and subscribe to my channel for more content. If you have a question about any of my content or this specific video, just please leave a comment down below. And as always, stay focused on your freedom. I'll see you next time.